The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everybody. Welcome to Squawkbox Europe. I'm Steve Sedgwick, and these are your headlines. Futures pointing to a positive open in Europe for equities, with attention on today's U.S. non-farm payrolls print and a potential high-stakes Supreme Court ruling on tariffs. Chinese inflation hitting a three-year high in December, but comes in flat for the year, missing official targets and adding to deflation concerns. And Glencore plus Rio Tinto confirming talks that could lead to a merger, potentially creating the world's largest mining company. Good morning, you very relaxed and glib bunch out there, because you are relaxed. You are incredibly relaxed about just about everything that is being thrown at these markets at the moment. Look at the moves on the week today. The Dow's up 1.8%, the S&P is up 1%, the Nasdaq up 1%, the Euro Stoxx 600 is up 1.3%. Markets around the world seem to still be on the front foot. No concerns about the upcoming payroll, no concerns about AI spend, no concerns about any of the valuation issues out there, and seemingly no concerns also about the tariff ruling that we expect to come potentially from the Supreme Court today. And despite the fact that there are many commentators out there that say this could be actually quite a big banana skin for the administration's tariff plans. Now, don't get me wrong. The administration can find all kinds of other ways to raise money from exporters into the US, and obviously when they hit the customs there are other ways of doing so as well. In fact, I'm looking at David Roche's copy, and he's just going through some of the rulings that they could use. For instance, 232 is one of them as well. You've got Section 338, which is the Tariff Act. You've got 122, which is the Trade Act. You've got Section 201, also in the Trade Act. So there's a lot of different measures that Scott Bessent and Donald Trump can use. But if you lose the ability to use the International Emergency Economic Powers Act, then that is a little bit of a fly in the ointment for the administration. And of course, are people then going to ask for some form of rebate? Anyway, in the meantime, the markets glibly ignoring everything we see. We saw the Nasdaq give back 104 points in yesterday's session, but by and large, it was a positive move to the upside. For the week to date, by the way, 9 out of 11 sectors are in positive territory, led by not technology, no, not the rebound in oil, no. What is it? Yeah, consumer discretionary, which is very interesting, especially given the fact that we've got these payroll figures later, and we'll just see maybe another little, albeit backward-looking indicator, snapshot on the US economy. Well, China's consumer inflation accelerated in December, and we can see there the Chinese markets really not worried about this data, but it accelerated in December to the fastest pace in nearly 3 years as spending picked up ahead of the New Year holiday. Prices rose 0.8%, in line with expectations and 10 basis points higher than in November. Let's have a look at the European futures. Yesterday, we saw European equities, well, a mixed bunch really. We saw a mixed picture in the UK retail scene. We saw defense stocks rallying on the back of hopes that the US is going to have a massive increase in spending if Donald Trump gets his way as well. But the indicators for the start of trading today are called higher. Week to date, I can tell you the DAX has had a brilliant week, outpacing most indices around the world, up 2.4% to the upside. The Stoxx 600, as I mentioned, is up 1.3% for the week. The FTSE has rallied 0.9%. The US futures, very early days for the US futures, but I'll give you a little look at them anyway. They are trading flat as a proverbial pancake. So, US weekly jobless claims rose by 8,000, whilst continuing claims jumped by 56,000 to 1.9 million, as hiring remains sluggish. However, a surge in worker productivity is sheltering the economy from the labour market slowdown. Q3 worker productivity grew 4.9%. That is the fastest in 2 years. That is a fantastic piece of data. Later, we're going to get December's non-farm payrolls report with focus squarely on the unemployment report following the 4-year high notched in November amid the government shutdown. Reuters' survey of economists forecasts an increase of 60,000 to the headline number, with the unemployment rate expected to ease to 4.5%. Okay, the US trade deficit narrowed to its lowest level since 2009 as imports tumbled amid the bite of Trump's tariff agenda. October's deficit shrank 39% versus September, although year-to-date the deficit is still 7.7% higher than the same period in 2024. Now, as I mentioned, the US Supreme Court could issue, because they don't tell us what they're going to issue in advance, but we think we're going to get today, a ruling on the legality of Trump's tariff agenda. Now, should the court rule against the tariffs and say they're an overreach of the president's emergency powers, the White House is still expected to pursue one of Trump's cornerstone policies. Of course it will. It will use multiple workarounds, and I mentioned some of them just now, that don't involve invoking the emergency powers under scrutiny in the case. The US Treasury Secretary, Scott Bessent, said the outcome would not impact the country financially.
What is not in doubt is our ability to continue collecting tariffs at roughly the same level in terms of overall revenues. What is in doubt, and it's a real shame for the American people, was the president loses flexibility to use tariffs, both for national security, for negotiating leverage.
Right, let's get another voice on this. Liam O'Donnell is head of macro and rates at Artemis. Liam, so many things to discuss with you today. Thank you for joining us nice and early. I do want to get to Venezuela and Greenland in a few moments' time, but what are you most excited about in the current session? Is it potential ruling from the Supreme Court and or the payroll?
Good morning, and thanks for having me. I mean, for me, it's really going to be about the NFP payrolls and wage growth in particular. I think if you look at the mix the kind of Fed is facing, inflation is still sticky. And, if you think that, tariffs are going to lead to continued inflation pass through, then you're really focusing on the labor market for kind of an anchor for kind of what's priced into markets in terms of lower rates this year. So I think if you start to see a bit more resilience coming through in kind of the labor market in terms of if it's wage growth or kind of hiring, then it really does kind of push back against the kind of current market narrative that we're going to see, lower rates in the US this year.
Liam, just looking backwards before we go forwards, why do you think there hasn't been a bigger effect on the labour market and inflation and data more generally from the extraordinary seismic events we saw that began on April 2nd last year?
Yeah, I mean, it's a really good question. I mean, I think we are seeing some pass through. If you look at, the measures of inflation, you've seen a kind of a tick up in core goods inflation over the last 6 months. I think in general, the kind of tariff shock, passed, relatively quickly because, you kind of saw an immediate kind of rollback from the administration, the kind of the taco trade, if you will, where when kind of markets really got concerned, there was some sort of kind of give back from the president. But I think, more generally, the general backdrop for the kind of US economy and for kind of the global economy as a result of kind of Liberation Day was a kind of a shift in kind of fiscal policy. And I think that was the biggest change in markets last year was the move from Germany, the move from China, the move from Japan towards a kind of a pro-cyclical fiscal spending plan. And I think that's what markets are really kind of focusing on into 2026 is the tailwind from fiscal policy. And I think that's why markets are prepared to potentially not ignore kind of risks on the horizon, but certainly kind of focus on kind of fiscal policy more.
Okay, we'll get to fiscal, but I think the market is ignoring those risks, and it may well be right to do so because you can only concentrate on one or two things at a time. But when I look at the fiscal position, and this isn't just about the States, it isn't just about Japan, it isn't just about what's going on in China, it is across the board. The fiscal position is worsening, and in some cases, Liam, and you know this as well as I do, way worse than when we had a sovereign debt crisis in 2009. it's almost like it's so slow burn, no one wants to care about it.
Yeah, well, I think bond markets are giving you a signal that, if you look at the shape of the yield curve, in the last kind of 12 months, we've seen a pretty significant steepening of kind of the yield curve. So that's markets telling you that, they're more sure about kind of near-term monetary policy and kind of less sure about, how governments fund themselves over the next kind of 10 to 30 years. And because of that, you're actually starting to see countries adjust for the fact that markets are a little bit more concerned about the kind of the fiscal policy trajectory globally. I think the kind of the key thing for kind of, the near term in terms of risks is even though budget deficits are, extraordinarily high, nominal growth is still strong. So from a kind of an optics perspective, you're really looking at kind of nominal government revenues and whether you can kind of fund the kind of debt servicing costs. And so far that's okay. But I think if you look at the kind of general response of government bond markets, the markets are really starting to put in a bit of a premium in kind of longer dated bonds as a result of this, regime shift, essentially. That's not just happening in the US, but that's happened globally. And I think that, 2026 is going to be more of that. 2026, the markets are going to continue to pressure, the long end of the curve. I think it's interesting that if you look at what's happened with the U.S. administration, when Scott Bessent came in originally, he was talking about we don't care about interest rates, we care about bond yields, and that kind of gave a strong support to kind of the longer end of the U.S. curve. That's been replaced with, well, we're just going to grow our way out of this. So I think it's something the market is really focused on. I think it's being priced into markets, and I can see it continuing this year.
That is fascinating. But if the market doesn't care about interest rates and just wants to focus on the fiscal position, then it's going to impact, as you're alluding to, those bond yields as well. So here's the problem for the central bank from May onwards, or whoever the new chair is. In fact, it's a problem now. But if we have a more dovish bias, if they do get a more aggressive bias in cutting rates stateside, is the bond market going to take notice? And given what you just said, I think the market might just try and challenge the Fed and what the administration wants by actually keeping those rates higher on the longer end.
I think you're absolutely right. I think that's what we really saw last August when the administration really started to pressurize both Chair Powell and other Fed governors. You saw a quite aggressive steepening of the US yield curve, which was very much by itself. It wasn't like global curves were steepening to the same extent, and you really saw some pressure on the long end of the curve. I do think that the market is kind of torn between whether it's going to be Kevin Warsh or Kevin Hassett. I think if the Fed push on either by external influence or by the new Fed chair governor being, overtly dovish, I do think the market is going to pressurize the long end of the curve. And I think that, if we're in a situation where, inflation is still around 3% and growth is averaging kind of 3%, I just cannot see the market, realizing, 2 cuts this year. And I think that, if you look at what's priced into the market right now, the first cut is priced for June. So it really is a kind of a question of, who is in charge. But I do think that the market will push back. The market has won before. If you remember the initial fallout from Liberation Day, where bond markets were essentially the catalyst for a change in the administration's direction. I do think we'll get there again.
Yeah, absolutely fascinating. I mean, God knows, even the prediction markets, they might get it wrong. It might actually be someone who's not called Kevin. How about that one? Let me move on to Venezuela and Greenland as well. You're prepped to talk about all these issues as well. Look, I get it why defence stocks are interested. I get it why oil stocks are interested. But no one else seems to care. I mean, is it right to ignore these kind of things, Liam?
I mean, I think with Venezuela, it's slightly different than the potential kind of foray into Greenland or potentially Iran. I think with Venezuela, it's not such a kind of a big a big driver of kind of, global demand, global output. I think with Greenland, I think it puts a lot of pressure on kind of the NATO alliance, on the Europeans in particular, to show some form of kind of solidarity with Denmark. And I think that, if you look at, the kind of the national security strategy document that was released last year, this is all very, very consistent with the rhetoric from that document. So I do expect a continued push, with respect to Greenland. Now, I think that, it's good, it's positive that, we're starting to see kind of signs of diplomacy with Marco Rubio coming over next week. But ultimately, I think that is the biggest risk, that you do have to see some sort of kind of sanctioned response from Europeans. And I think that if the kind of Greenland situation does escalate, I do think markets will pay more attention. But for now, I still think it's early days.
Yeah, I mean, I've got to be honest. I can't see how the Greenland situation escalates, apart from in a very binary way. The Americans either invade or they don't. And if they don't, then, great. I don't see what they can have the mineral rights anyway. They can have the soldiers on Greenland anyway. The Danes haven't got a problem with any of that. They never have had a problem with that, and neither have the Greenlanders. The problem is if the Americans decide it's theirs and the Europeans saying, no, it's not. I see it as very binary, Liam.
Yeah, well, I mean, I wouldn't give up on diplomacy 100%, but I do think, it is the biggest risk for markets. I think that markets over the last kind of 4 or 5 years, whenever risk has presented itself, and we've seen a market, wobble or market drawdown, the length of these, risk market wobbles and drawdowns are kind of shortened dramatically. If we go back kind of 10 to 20 years, kind of a drawdown might last a couple of years or a couple of quarters at least. The drawdown that we saw in kind of Liberation Day was of the order of weeks. So I just think that the kind of post GFC, post-pandemic narrative has always been to kind of buy the dip. And I think that, that's been because, central banks have been there to be able to loosen policy, aggressively. I think that we're now reaching the stage where, if we are in an environment where central banks, by and large, are done cutting rates, you can make the exception of potentially the US and the UK, but by a large extent, we've had all that we're going to get from kind of central banks in terms of lower rates. And if you actually look at, what the market is pricing, the average G10 policy rate is actually expected to be higher, this time next year. So I do think, the markets have had a great run in terms of, always buying the dip. The markets have been, supported by, extraordinary central bank policy for years. I just don't think that kind of anchor is there going forward. So as I said, I think that even though I'm relatively, optimistic on kind of the growth outlook, I do think, asset markets do face, some challenges this year from kind of the lack of monetary support.
Yeah, really interesting, Liam. Thank you so much for joining us. Have a great rest of your day and a great weekend as well. Liam O'Donnell, who is head of macro and rates at Artemis. Coming up on the show, France starts the new year. Well, I hope they started the new year a week or so ago, but anyway, maybe they were on holiday. France starts the new year as it ended the last, looking to thrash out a budget. We'll ask Charlotte what's changed and what 2026 has in store, including whether we could see parliamentary elections. Plus, a mega mining deal could be back on. We'll explain why surging copper prices could help create the world's biggest miner. And UK Trade Minister Chris Bryant hails the country's pharmaceutical deal with the United States, telling CNBC he agrees with President Trump after the government agreed to a major increase in the amount the NHS pays for drugs. I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. I'll come to the next segment in a moment, but I think this is massive. Honestly, I'm not trying to big up something that isn't, but When I get in the car, I listen to all kinds of things, CNBC, Wall Street Journal, FT, whatever. So I drive in the mornings. And the first story, the big story at the top of the FT was this one. And this is the Financial Times. And they got all kinds of journalists. 1, 2, 3, 4, 5 of their top journalists on it, including Sam Fleming, Emma Dunkley and George Parker as well. So they put all the big guns on this story in the FT. UK to exclude financial services from push for closer EU alignment. City of London firms have been lobbying against the return to Brussels rules. I kind of had to listen to the headline again when I listened, and it's a great article. So have a go at that when you can do it and watch CNBC and look at our website. There you go. You're all ambidextrous. But I thought it was enormous. Think about it. London financial companies lobbying against more equivalence with the EU, when they lobbied for years to have more equivalence, to not have different rules, because they were worried that Brussels... Do you remember all that conversation? We did it for years from 2016. Charlotte did it for years. She's sitting on stage. She doesn't want to get involved. They did it for years. Morning, Charlotte. They did it... Well, actually, you remember that. The British companies were lobbying because they were worried about Dublin. They were worried about Milan. They were worried about Paris. They were worried about Frankfurt. All these other places. And I think it's absolutely extraordinary that there is a complete volte-face. Volte-face. There you go. I have to. She's only here for my French lessons. Seriously, I think it's quite extraordinary. Now they're lobbying against it. And when you think about it, look at all these companies who are building headquarters at Canary Wharf, building headquarters in the City of London. I think that is fascinating. It's a story I'm going to bang on about for ages. And if you don't like it, well, you can always email me. You know the address, steve.sedgwick. Anyway, the UK government is reportedly set to exclude financial services firms from closer alignment within the EU single market, according to the Financial Times, which says the companies have lobbied against a move to follow EU rules as ministers seek closer cooperation. The UK Trade Minister, Chris Bryant, expects to have, quote, a very British... What's that mean? This is the quote. A very British version of our relationship with the EU. What does that mean? We have a cup of tea or something? I don't know. Anyway, speaking to Whittaker yesterday, he said he wanted to achieve frictionless trade with the bloc.
I've heard lots of different versions of this. The customs union, a customs union, the single market, and so on and so on. Basically, what I want to achieve is more British businesses being able to do business with Europe easily and without unnecessary barriers. And the truth is that Brexit has thrown up a whole set of different kinds of barriers. Sometimes that's about mutual recognition of professional standards. Sometimes it's about, it's not about tariffs, but it's about a whole series of other things that we need to sort out. So we're in the process of dotting the I's and crossing the T's on an SPS deal, which is around food and sanitary, all of that kind of stuff. And one of the things I'm always interested in is how that affects florists, because florists have really struggled. 85% of all flowers sold in the UK have come through the Netherlands into the UK. The barriers have made it more expensive and more difficult. So what can we do to make that easier? And the same is true of foodstuffs and so on. But I want to achieve frictionless trade, which is what everybody who was in favour of Brexit argued we were still going to have. I want to achieve frictionless trade with our single biggest market. I think the EU still represents something like 41.1% of all our exports, so single biggest market. We need to get that right.
And do you think the customs union, or a customs union, however we want to word it, is maybe the right way to go about it? Or do you think it's a single market? Or
No, so I'm not arguing it for any of those specifics. I think we will end up having to have a very British version of our relationship with the EU. I mean, it's interesting, isn't it? Our defence and security relationship is now probably stronger than it has ever been because of the events in Ukraine. And that poses sovereignty questions, which were some of the issues that everybody threw into the discussion about Brexit back in 2016. And it feels as if we've sort of gone, oh, well, people can just get on with trading. Actually, I think we're going to need to work really, really hard. I know there are lots of people in the Commission and in the member states in Europe who want to sort many of these issues. Another bit that matters a lot to me is British musicians being able to tour in Europe. It's not just Elton John. I mean, it's the much younger generation who are keen to be able to do that. And I've had people who run music festivals in Europe saying, and opera houses saying, we can't get British artists touring around Europe. It's one of the kind of issues that we need to resolve, and was in the referred to as one of the discussion points in the deal that we struck in May. Again, it's an iterative process, this, I think. I sort of think of it as like a jigsaw puzzle. So we're going to do the SPS bit, phytosanitary stuff. We're trying to do stuff around mutual recognition of professional standards, and then we're doing stuff around electricity charging and that market. So it's putting together all the bits of the jigsaw puzzle so that it looks like frictionless trade.
You've got enough flags in that shot. Charlotte pointed out, you've got 2 flags. Okay. Right, the French president, let's get back to France. We haven't had a look at this one yet this year. French President Emmanuel Macron says the country will vote against the Mercosur trade deal that the EU is due to sign with the South American nations. Macron said there has been a unanimous political rejection of the free trade agreement, in France, I should add, as farmers blockaded roads into Paris. Would we notice, though, what the French farmers are blockading about? Okay, apparently it was Mercosur this time. European nations will vote on the deal today. Ireland has already said it will not back the proposal, but Italy, whose vote could be decisive, signalled it would back the agreement, potentially paving the way for it to be adopted. Well, French lawmakers have resumed negotiations on the 2026 budget with the Prime Minister. He was Prime Minister twice last year, Sébastien Lecornu, keen to avoid forcing it through Parliament and risking the collapse of his government via a no-confidence vote. The government wants the budget passed by the end of January, but faces strong opposition from the Socialists. Charlotte, happy 2026. Why don't we just cut and paste probably the conversation we had at the start of 2025 or even the start of 2024?
Yeah.
La plus ça change, la plus la même?
Plus la même. Oui. Some of the issues are here to remain, for sure. Some of the political uncertainty, instability, it's a minority government, so we'll have more of this drama this year. But it might get even worse, because we are this year just a year before the presidential election. So all this come into play now this year as well. So the first challenge of this year, of course, is the budget. As you were just saying, the negotiations have just restarted around this. Last year, at the end of last year, they passed just a social security budget and they passed an emergency legislation. So there's no shutdown in France. So things keep running while they try to find an agreement. Of course, it is complicated because it is a minority government and they need to keep on board the center-right and the center-left, and it is particularly difficult. Part of it is the suspension of the pension reform. So they're working on all this. Of course, the aim is to lower the deficit under 5% if possible, from 5.4% in 25. So they're working on all this. They're under heavy pressure. One hand, you see, for example, the farmers in the street because of the Mercosur. The government promised some extra support for them, but that will happen only if a new budget comes into play. So that's one of the elements. The extra spending on defense that President Macron has been talking about last year, again, that would fall under the new budget. So all this is adding political pressure there on the government. It looks like they should be able to come to an agreement by the end of this month. Again, the government said they will not use the 49.3 mechanism, so push through without a vote. So they have to find a compromise. So that will be tricky. But here again, the political calendar will catch them up very, very quickly, because in March there is a municipal election. So the whole country will be voting for mayors in March. And that's important because it is the very last national election before the presidential of 2027. So it will give us the political temperature in the country and where the different parties stand. So it will be very important to see that. And finally, next week, the appeal for Marine Le Pen will start. And that is a very important one. At the moment, she's not allowed to run, the far-right leader, in an election because of a trial last year around the misuse of EU funds. The trial, the appeal for the trial is happening, has been accelerated, so we can know if she can run by this summer in the presidential election. So all this comes into play. President Macron cannot run again next year as president. So the other race here is who will replace him? Who will be the heir of the movement? And here, that's another battle in the background, whether it's Lecornu, whether it's Edouard Philippe, former prime minister. Yes. So all this is happening this year. So we'll have certainly more drama.
Very exciting.
Yeah.
And will the phrase canard boiteux work? Does that work in French?
Yeah.
It works in French. Oh,
yeah,
good. Okay, right. Well, for those of you who aren't going to look it up in the meantime, we'll have a look what canard boiteux means later on. Thank you. Since the start of the century, France's productivity has been slipping, despite the best efforts of President Emmanuel Macron. As the 2027 election approaches, CNBC's Gay Legrand, we have many French people at CNBC, takes a look at the health of the French economy.
For a long time, France ranked amongst the most productive countries in the world, but that has recently changed. From the turn of the century, productivity growth rates, measured as the value added to GDP per hour worked, have been slipping. After COVID, it got even worse, and like much of Europe, the country has struggled to find its way back towards growth.
Purchasing power is actually stagnating, like in many countries, but more in France than elsewhere, in part because we have underinvested in many things.
Yet, in 2017, when Emmanuel Macron won the French presidential election, his economic program was going to bring a renaissance to the country, notably through the Startup Nation concept. Its launch was embodied by Station F, the world's largest startups campus.
With the former president, it was really this feeling of France is hostile to entrepreneurs. When Station F arrived, Macron arrived, that really changed. People understood that it's okay to launch a business here.
In 2016, France counted only 3 unicorns, companies worth $1 billion or more. By 2025, that number had increased by a tenfold to 30 unicorns. Another success of Macron's was reducing unemployment, France's long-standing bugbear since the 1990s. However, France's youth is still out of work. Although following the same trend as other age groups, youth unemployment still stood at 18.5% in 2025, a stark contrast to Germany's 6.6% rate. And while fixing employment is a priority in most countries, it's especially key in France. That's because pensions are mainly funded through employees' contributions. In 2025, pensions cost a total of 388 billion euros, or 13.8% of the country's GDP. Add to this state subsidies, and it's easy to understand why the country is drowning in debt. So, is France doomed to remain trapped in a cycle of high debt and heavy spending?
France right now is really a good example of zero-sum thinking, basically viewing the economic life as a zero-sum game. So the pie is fixed and we fight to grab the biggest share in a sense. Forgetting that in this fighting, we actually reduce the size of the pie instead of trying to increase it through economic growth, innovation, productivity gains, and so on. We have to invest for our children, not give them a totally indebted country which has no room for maneuver.
And on our website, that article and the associated piece is there from Gaël Legrand. Right, let's take a look at the futures. A little bit late to break. I think that was Charlotte's fault. We are called mildly higher in equities at the start of trading in around about, it's only 27 minutes away now.